You know that feeling, right? You spot a perfect chart pattern, one you've seen in every trading book. You take the trade, feeling confident. And then, boom. The market just snaps back, stops you out, and leaves you wondering what on earth just happened. Well, it turns out one of the most famous patterns in trading is often a trap, and it's designed to do exactly that. Welcome to AI Explains ICT. Today, we're diving into a really powerful concept from ICT's core content, specifically Month 3, Episode 8. And I'm serious, you're going to want to grab a pen and paper for this one, because what we're about to cover could totally change how you look at the charts. So here's how we're going to break it all down. First, we'll quickly go over the textbook pattern that everyone learns. Then, we'll get into the good stuff, why it fails so often. The secret, as always, is understanding the institutional perspective. We'll walk through 2 real-world case studies, a bear trap and a bull trap, and then we'll finish up with a new framework so you can actually trade these setups. Okay, so let's start with what everyone thinks they know. Before we can dismantle the myth, we have to understand what the myth is. This is the stuff you'll find in literally any intro to trading book on the shelf. First up is the classic head and shoulders pattern. It's seen as the go-to bearish reversal pattern. The idea is simple. You get a peak, that's your left shoulder, then an even higher peak, which is the head, followed by a final lower peak, the right shoulder. The rulebook says once the price breaks below that neckline connecting the lows, it's time to hit the sell button. And here's the classic diagram you always see. You've got the 3 peaks, that neckline connecting the 2 valleys, and the standard way to project a target. Traders are taught to just measure the height from the top of the head down to the neckline, and then project that same distance down from where the price breaks out. It seems so clean and mechanical, right? Of course, there's a bullish version too. It's just the inverse of the topping pattern. And as you'd expect, it's called the inverted head and shoulders. This one is supposed to be a sign that the market has found a bottom. So instead of peaks, you get 3 troughs, and a break above the neckline is supposed to be your signal to buy. And the structure is literally just flipped upside down. You get a low for the left shoulder, an even lower low for the head, and then a higher low for the right shoulder. The textbook play is exactly the same, just in reverse. Measure the distance from the head to the neckline and project that distance up from the breakout point. This is pure trading 101. Okay, now for the most important question. If this is one of the very first things every trader learns and it's so well known, why is it so incredibly hard to make money with it? Let's pull back the curtain on the hidden flaw in this whole idea. Just think about that for a second. If a pattern is common knowledge, I mean everyone knows it, that means everybody is looking at the exact same thing. Everyone is putting their entry orders right at the neckline and their stop losses in the same obvious places. Now, what do you think happens when the smart money knows exactly where a giant pile of orders is just sitting there waiting to be taken? And here is the absolute key insight from ICT. The number one reason this pattern fails comes down to one word: context. Retail traders, they spot these patterns on the lower time frames, the 15-minute chart, the 1 hour, and they trade them completely in a vacuum, totally ignoring the bigger picture, the dominant trend on the daily or weekly chart. They get married to the pattern, not the overall direction of the market, and that makes them predictable and an easy target. So this brings us to the institutional perspective. This is where we shift our entire mindset. We stop thinking like the prey and start understanding the predator. I promise you, this part will fundamentally change how you look at a price chart forever. This slide says it all. It's a tale of 2 viewpoints. The retail trader sees a head and shoulders forming and gets excited, preparing to sell the breakout. The institution, they see the exact same pattern and think, oh, look at that. Look at all those sell stops building up right below that super obvious neckline. That's a beautiful pool of liquidity. For them, the pattern isn't a signal, it's bait. And don't just take my word for it. This quote from ICT just hits the nail on the head. He says that these patterns are often engineered. They are deliberately painted on the chart to trick retail traders into taking one side of the market, which allows institutions to swoop in, take the other side, run all the stops, and profit from that completely predictable reaction. All right, theory is one thing, but let's see this trap in action. Our first case study is a textbook bear trap, where what looks like a perfect topping pattern is actually designed to trick sellers in a market that's really bullish. So the most important step, always, is to start on the higher time frame. Here we have a daily chart of the British pound against the US dollar. You can see prices traded down into a bullish order block and found clear support. This is our big clue.
It tells us the institutional order flow is pointed higher. The overall bias is bullish.
Now let's zoom in to the hourly chart during that same period. And what do we see? A beautiful, picture-perfect head and shoulders pattern. Retail traders, completely ignoring that bullish daily chart, see this and think, aha, the market is topping out. They get all geared up to sell, and they stack their sell stop orders just below that clean, obvious neckline at 1.5550. This, right here, is the bait. And here it is, the trap gets sprung. The market makers push price just enough to break below the neckline. All of those retail sell orders get triggered, which provides a massive flood of liquidity. Institutions use that selling pressure to fill their buy orders, and then, with their huge positions on board, price reverses, and I mean violently, to the upside, perfectly in line with the bullish daily trend. And where does it go? Straight for the buy stops resting just above the head of the pattern. All those sellers are now trapped. Okay, let's flip the script and look at the exact opposite scenario. Now we're looking at a bull trap, where what looks like a perfect bottoming pattern is used to lure in buyers right before the market tanks and continues its bearish trend. And again, we start with the daily chart to get our bearings. In this case, price has rallied up into a key bearish level known as a breaker. The institutional order flow is clearly pointing down. Our high-level bias is bearish, which means we should only be looking for reasons to sell. But look what happens on the lower time frame. A perfect little inverted head and shoulders pattern forms. So breakout traders see this, they think the market has finally bottomed out, and they get ready to buy as soon as price pokes above the neckline. They place their buy orders, and in doing so, they create a nice juicy pool of buy-side liquidity. And there it is again, like clockwork. Price breaks above the neckline, triggering all those buy orders. This allows institutions to fill their massive short positions at a great price. And as soon as their orders are filled, that buying pressure just vanishes, and the market sells off aggressively, heading straight down, right in the direction of the daily trend. All those buyers are now trapped in losing long positions. Okay, so we know how the trap works. We can see it on a chart. The real question is, how do we avoid it? And better yet, how do we use it to our advantage? This is all about changing your perspective, from being the liquidity to trading alongside the institutions that are hunting for it. So here it is. Here's your new framework for trading the trap. It's a 5-step process. Number 1, you always start by identifying your higher time frame bias. Is the market bullish or bearish? Number 2, now you look for a classic pattern on a lower time frame that is trading against that bias. Number 3, you have to see the neckline not as an entry point, but as a target for a liquidity grab. 4, instead of joining the breakout with the crowd, you fade it. You trade against them, but in line with your higher time frame bias. And finally, number 5, your target isn't the textbook projection. It's the liquidity on the other side of the pattern. That's where the real move is going. The biggest takeaway from all of this is to stop seeing these classic patterns as simple entry signals. Instead, start seeing them for what they really are, a map that shows you exactly where the liquidity is building up. Once you can make that mental shift and see the market from an institutional perspective, these traps stop being a threat and start becoming incredible opportunities. If this video gave you an aha moment, please give it a like and subscribe to the channel. And if you have any questions, drop them in the comments below and a human will be sure to get back to you. Safe trading!